Hi everyone, this is Alan from Rawlo Financial. So if you're watching this video right now, that means that you'd like to know if we're going to have a massive stock market crash in 2024. Now, YouTube and the internet is littered with videos and articles basically saying that the world's going to end and everything's going to crash. It's going to be like 2008 to 2009 all over again. Now, obviously, if you're an investor, this is quite worrying. So you or me, we want to know the details. We want to know why these things are being predicted. How accurate is it going to be, and how much does it matter? So first things first, we're probably going to have to take a look at the Federal Reserve and central banks in general. So central banks, they have the ability to raise rates and also lower rates. So that is basically either tighten money supply or loosen money supply and lending conditions, thereby stimulating the economy or tightening the economy up. So at the minute, for all central banks, well, I should say the majority of the Western central banks have been in a hiking mode, and then as of late, they have paused. Now, I want to show you this chart because one of the most interesting charts that we're going to go off that people seem to basically take their predictions from is this here. So this is the federal funds effective rate, and as you can see here, it's quite a simple chart, but almost every time, like there, 7 months, for example, that's when the Fed pauses and then it begins to lower. Again, it does the same here. For 13 months, it paused and held rates that high. It did the same again here for 7 months and then it lowers. So if you look, the pattern is pretty consistent. Those pink little spots there, they represent a recession. So it's kind of the Fed hikes for a certain amount of time, it then pauses, it starts to lower, and just after the lowering, that's when we tend to see the recession. So we've been on a hiking cycle in the West. Bank of England have done it, the Federal Reserve have done it. They've hiked to where we're at now, about 5.5%, whatever we're at in different nations. And the Fed and Jerome Powell and people like that, they're already starting to talk about a federal pause, essentially. In fact, it's even indicated that there could be loosening sometime in the future. Now, that's got markets a little bit giddy. And the reason that they're giddy is they're anticipating a flood of money coming soon and ideally, the next leg up and the next rally. But first, we have to get over, will there be a massive stock market crash and recession? So at some point, guys, let's be honest, there's going to be a recession. They're going to be, but the variables are, how long will the recession last? How deep will the recession be? The stock market could crash, but what is a crash defined as? Is that 5%? Is it 20%? Is it 50%? Now, in my humble opinion, I'm a dividend investor and I'm looking for the long term. So I would look to invest no matter what through any sort of time period, any sort of crash, because ultimately you're looking to average down into that market. You're looking to put your money to work, and it's really difficult to time the market. In fact, I'm going to show you a quote by legendary investor Peter Lynch. So this is what he says. Far more money is being lost by investors in preparing for corrections or anticipating corrections than has been lost in the corrections themselves. So, everybody likes to believe in essentially the worst, right? We all like to think that if the crash is just over the horizon, why don't I take my money out? I sit on the sidelines, I hold this cash. Makes sense, right? I just hold on to it. It crashes, I buy everything at super low prices, ride the next leg back up. Well, if it was that simple, everybody would be rich, wouldn't they? The problem with that is people were anticipating the crash. You could go into the YouTube, for example. You can type in stock market crash of 2017, stock market crash for 2018, stock market crash, and basically you get the idea. Somebody's predicting it every year. It's just constant in a loop. It'll be next year, it'll be the year after that, it'll be the year after that. Now, in my opinion, we're going to have a crash at some point. I don't think it's going to be quite as bad as the 2008 crash. Will it be about 35-40%? It could be quite deep like that, yes, at some point. The problem is, do I think it's going to be next year? Probably not. I actually think the economy is more robust than people think at the minute. It's not kind of the same setup as it's been in previous years. I actually think if we do have any sort of crash, it will be towards the end of next year, maybe even mid 2025. Now, again, that doesn't mean that I would advise you take your money out. and you sit on the sidelines, you just average down into good stocks. Good stocks will survive a recession no matter what, and you just want dividend income. So any crash that does happen, by all means, you should look to take advantage of that. And the best way to take advantage is to keep deploying your cash. Every time you get that money in, you get those paychecks in, you get that extra income, you deploy it into good, strong dividend paying stocks. You average down, and that way, guys, when a stock market crash does come, you know, you're not scared out of the market and you're not jumping in and out every 5 minutes, because there's a chance that you could take your money out now, wait a whole year, wait 2 years, wait 3 years, and that crash that you were waiting for never comes, never materializes. Or alternatively, it could crash and you think, well, I'll jump in when it gets to a 60% crash, a 70% correction. That seems really good for my stocks. And it never gets to that. It might only be a 15% correction. And you sat there on the sidelines with all your money waiting for that golden opportunity. You know, it's really difficult to predict. If it was easy, we'd all do it. We'd all be multimillionaires by now. So what I'll be looking to do is just constantly deploy every time I get money. So that might be every month, that might be every 2 or 3 months. And I'll just continually buy what I consider are titans, you know, big healthy stocks with fantastic history of paying dividends, fantastic history of riding through recessions and not going bankrupt, because that's a key as well. You want to know that your company is healthy and that it can outweigh any sort of disruption, including, you know, market crashes, and just ride it out, guys. That would be my thing. But I actually think in terms of a prediction, I don't really think it's going to happen next year. I think the economy might be weak. You might get a flash crash, sort of a little bit of weakness in the market. But I don't think that this big almighty crash that everybody's that everybody's looking for and everybody's writing about and making videos about, I don't necessarily think it's coming next year. The last leg to fall out will be unemployment. You know, unemployment across most nations at the minute is still fairly low. When that falls, that is when, you know, usually people struggle for money and there's a massive impact on the stock market. It's not gone yet. It doesn't look like it's going to go anytime soon. We could be paused for quite a while, guys. And then obviously the Federal Reserve usually lowers rates. And then after that, sometime, that's when the crash happens. Now, I'm going to point out something as well about central banks. In the past, like for example, in 2008 to 2009, the banks were very reactionary. They saw the crash happen, they panicked, and then they intervened. And at the time, it was what was it, hundreds of billions? We're way past that now. So the point is, they're trying to be a lot more proactive. So I think if they even hint that the market's going to crash, they're going to jump in a lot sooner than they have done in the past. But more importantly as well, they'll deploy a lot more money than they have in the past. So I think that, I mean, don't get me wrong, that won't stop the market from crashing altogether. But I think that they have essentially taken away a kind of 2008, 2009 gigantic crash where you or I get to just swoop in and buy stocks for pennies and make, you know, the most of it. That being said, they still can crash, you know, they still can be scary crashes. That can be scary sometimes for people. If you're a long-term investor, that's not so scary. It just comes part and parcel, you know, stocks go up as well as down. And if you're looking for the long term, that shouldn't bother you. It's just more opportunity to buy great stocks at great prices, guys. So hopefully that answers your question. You know, hopefully you can feel a bit more easy. Hopefully you take a long-term approach like myself. I'm looking to compound my dividends mixed in with any money that I can get as well, and just keep on adding until I can get big, fat, juicy dividend payments to help me with my lifestyle. Anyway, guys, thank you for watching. I've enjoyed making this video. Leave a comment below if you want. Let me know what you think. Maybe you think I'm totally wrong and there's going to be an absolute crazy 70-80% crash next year and I don't know what I'm talking about. Or maybe you agree with me. Let me know your points and the data that you're looking at. If you do disagree, let me know why you think it's going to crash and what you think is going to spur that on at the minute. Thank you for watching, guys.